Hey everyone! Today we're diving into another popular debate in the investing world: growth versus value investing. Which strategy comes out on top? Well, buckle up, because we're about to break it down and maybe even throw in a few surprises along the way. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. First things first, let's define what we're talking about. Growth investing is all about finding companies with big potential for rapid expansion. These are the high flyers, the innovators, the ones that might be changing the world but aren't necessarily profitable yet. On the flip side, value investing is about hunting for bargains, companies that the market has overlooked or undervalued for one reason or another. Now, I've spent a good chunk of time researching this topic, and I've gotta say, the answer isn't as clear-cut as you might think. Spoiler alert, neither strategy is definitively better all the time. But they do have their own strengths and weaknesses, and depending on your goals and situation, one might be a better fit for you. Let's start by looking at historical returns. If you're thinking, past performance doesn't guarantee future results, you're absolutely right. But it can give us some interesting insights. When we look at the data from 1927 to 2021, we see some interesting trends. In the short term, like single-year returns, value stocks tend to have a slight edge. They often beat growth stocks by about 1 to 2 percentage points each year. But here's where it gets interesting. At the extremes, growth stocks had better minimum returns, while value stocks had better maximum returns. Not what you'd expect, right? Over longer periods, like 40-year stretches, value stocks generally came out on top. They had better average returns, better median returns, and even performed better at both the high and low ends of the spectrum. It's like the tortoise and the hare, slow and steady seems to win the race. But hold up, we're not just talking about returns here. What about volatility? After all, nobody likes a roller coaster ride with their investments, unless you're into that sort of thing. Well, value stocks seem to have an edge here too. They tend to be less volatile, with lower standard deviations in their returns. They're also more consistent in hitting that sweet spot of at least 6% inflation-adjusted returns over 40-year periods. Now, let's talk about what happens when things get rough. You know, those market downturns that make everyone panic and start Googling how to build a bunker. On average, value stocks tend to fall less during these periods. They're like that friend who stays calm when everyone else is losing their heads. But here's where growth stocks get their moment to shine: they tend to bounce back faster and harder when the market starts recovering. It's like they've been waiting in the starting blocks, ready to sprint as soon as the gun goes off. However, and this is a big however, value stocks seem to catch up and even overtake them as the recovery progresses. So, what does all this mean for you, the investor? Well, if you're looking at the really long term, value investing seems to have a slight edge. It's generally less volatile, more dependable, and has produced better returns over very long periods. But here's where I'm going to throw a curveball at you. The world is changing, and fast. We're in an era of rapid technological advancement, disruption, and innovation. The companies that are leading this charge often fall into the growth category. Think about the tech giants that have dominated the market in recent years. They started as growth stocks. So, does this mean we're entering a new age where growth will consistently outperform value? Honestly, I'm not convinced. Here's why. 1. Market cycles. The market goes through cycles, and what's hot today might not be tomorrow. We've seen periods of growth outperformance before, only for value to come back strong. 2. Mean reversion. In investing, there's a principle called mean reversion. Basically, things tend to even out over time. If growth stocks have been on a tear, they might be due for a cooldown. 3. Valuations matter. As growth stocks become more expensive, their potential for future returns can decrease. Meanwhile, undervalued stocks have more room to grow. 4. Regulatory environment. With big tech facing increasing scrutiny, the regulatory landscape could shift in a way that favors value stocks. In the end, though, you really don't have to choose just one strategy. In fact, I'd argue that for most investors, a mix of both growth and value is the way to go. Here's a unique take on this whole debate. What if we're asking the wrong question? Instead of growth versus value, which strategy wins, maybe we should be asking, how can I use both growth and value principles to build a robust portfolio? Think about it this way: growth stocks can provide that exciting potential for big returns, while value stocks can offer stability and income. It's like having a balanced diet for your investment portfolio. But wait, there's more. There's another factor that doesn't get talked about enough in this debate: your personal investment style and goals. Are you the type of investor who can stomach big swings in your portfolio value? Do you get a thrill from following innovative companies? Then you might lean more towards growth. Or are you someone who prefers steadier returns and likes the idea of buying undervalued assets? Then value might be more your speed. Your time horizon matters too. If you're young and have decades until retirement, you might be able to take on more risk with growth stocks. If you're closer to retirement, the stability of value stocks might be more appealing. And let's not forget about your financial situation. If you're regularly adding money to your investments, those big dips in growth stocks during market downturns can actually work in your favor. You're buying more shares when they're on sale. But if you're relying on your portfolio for income, the steadier nature of value stocks might be preferable. So, what if we stopped thinking about growth and value as separate strategies and started thinking about them as tools in our investing toolbox? Imagine you're building a house. You wouldn't use just a hammer or just a screwdriver, you'd use both, along with a whole range of other tools. Each has its purpose, and you choose the right one for each job. Similarly, in investing, growth and value strategies each have their strengths. The key is knowing when and how to use each one. For example, in sectors with rapid technological change, a growth approach might make more sense. But in more stable, mature industries, value investing might be the way to go. Or you could use a barbell strategy, investing in both high-growth, higher-risk stocks and stable, value stocks, with less in the middle. This way, you're positioned for big gains but also have a safety net. You could even think about it in terms of company lifecycle. Many successful companies start as growth stocks and eventually transition to value stocks as they mature. By understanding this lifecycle, you can potentially benefit from both strategies with the same company over time. The bottom line is this: don't get too caught up in the growth versus value debate. Instead, focus on building a diversified portfolio that aligns with your goals, risk tolerance, and investment timeline. Use both growth and value principles where they make sense for you. Remember, the most important investing decisions aren't about growth versus value. They're about your overall asset allocation, diversification, and staying consistent with your investment plan. So, which strategy wins? Plot twist, you do, when you understand how to use both effectively. That's all for today, folks. If you found this helpful, don't forget to like, comment, and subscribe. And hey, let me know in the comments, are you team growth, team value, or team why not both? Until next time, happy investing.